so much for staying with us right here on the Trading Bell. And of course, with my panel right here, we're discussing some of the issues that we saw emerge in 2019 that had an economic impact, and also what we're seeing happening already in 2020, as well as the continuing effect and what we're going to expect for the rest of the year. So even as we come back from discussing about the rate cap repeal, we also talked about retrenchment in 2019. Something else all of you mentioned was the pending bills. So county pending bills are something that have been addressed, continuously, and now the CS for Treasury, that is Ukur Yatani, also last year November, he talked about 15 counties that had not paid any bills at all. And just shockingly, that had a list of major counties, including Nairobi County, Mombasa, we had Kiambu, Garissa, and many more. So when we talk about the payments, if they were to start, flowing, and how quick would that sort of bounce back be for businesses that are then receiving this money, Gishoi, do you think?
Well, there's usually a lag effect, because then you can imagine somebody who's not been paid, say, for 2 years has gained a considerable amount of debt, to just support their working capital. So I can imagine when they get paid, they have to deal with that fast. So they'll probably not be going directly into reinvesting those funds to grow the business, but rather to sort out the problems that have already, bogged them down so far. And so I think that there will be a lag effect in terms of from them getting paid and seeing that effect directly, because then again, future income comes from investment now. And if those funds are going to be going to sort of cover the holes that have already appeared, then, again, we just spoke about retrenchments. Then suddenly now you need to start bringing back those guys who've probably found something else to do. I think retrenchment is a very expensive thing, because then you trained those guys, they knew what happens, and then now you need to bring in new guys probably. It can cause that process to be a bit slow, yes.
It's almost like a ripple effect then, in that sense.
Yes, there is a ripple effect.
Emily, what's your take on
that? As Gishori said, well, you are waiting for your funds. You've delivered the service. You've used up your capital. You're given the funds. You take care of probably the loans you had taken to service the project. And at least it'll be gradual in my thought, considering also the projects will have now to be completed, because to realize the value of the project that was being done or by counties, now with the contractors, they'll be able to complete the projects. Then now there'll be more circulation in the economy, and my thought will be also, as the projects are completed, there'll be that realization of the value of those projects, be it roads, be it hospitals, renovations, schools. Yes, I think with the release of funds timely, it will clear up at least the backlog. That will now give it that lag, but continuously it will adjust as makes things efficient.
Okay.
Yeah.
Now let's get to the issue of debt, because we saw the debt ceiling hiked to 9 trillion, and even from the Parliamentary Budget Office, we're seeing that they're projecting public debt to approach about 6.5 trillion this year. So expectations are that this will ease in the second half of the year. But what's your take, Sarah? What do you think?
So currently, revenue is below target, and revenue is what would help the government plug the deficit. And so revenue is below target. The government had stated that there will be fiscal consolidation. However, we're not seeing that. And I think one of the reasons for that is because majority of its expenditure is on recurrent expenditure. So that is like 65% is actually recurrent expenditure, which is very hard to cut because it includes wages and salaries and pension payments. So for that reason, expenditure is unlikely to reduce. And we've seen the latest figures the government has released for the first quarter of the fiscal year show that revenue was below target, and yet recurrent expenditure was above target. Development, they managed to reduce that slightly, and the overall deficit actually was above the target. And so for that reason, to plug this deficit, the government needs to borrow. And so in my view, it's likely that they'll increase the target borrowing, that's domestic target borrowing, and so debt will continue to grow. That's my view.
Okay. We've also seen when it comes to these recurrent expenditures and things like that, that austerity measures are trying to be implemented to curb a lot of that, I would say, ballooning effect of, something that maybe does not need to be something that so much money is poured into. Kishore, do you think those have taken any sort of impact when it comes to reducing the amount of money that there is being poured into perhaps things that are not relevant as much as it would be in the grand scheme of things?
Well, I think our biggest problem is the holes.
Yeah.
I mean, corruption, and that's, of course, we can see the fight happening, but of course it's slow and tedious because it's been done in the legal, within the legal, bracket. The thing is that if those holes can be plugged, and also maybe focus needs to turn from. We have done a lot of infrastructure projects, SGR, we're seeing the road network. Nowadays you can drive long distances without, seeing or using a gravel road. So that has been done. The question is now the new borrowing or whatever we're going to do with whatever we're borrowing or whatever revenues we have, it needs now to shift from just infrastructure to enabling. I remember one of the leading industrialists saying we should be thinking about what are we going to put on that SGR to take it back to Mombasa. Right now we're just fighting about bringing stuff from Mombasa inland, which means it just depends. We're a net importer. We need to become an exporter. So I think that the focus is what needs to happen. The austerity measures are good. We can't really, and again, tax is increasing. We can't tax. You can't build on tax. You need to build on creating an investment environment which creates more revenues, because those revenues, of course, are what gives you more taxes. So we have to make sure there's a very good balance in whatever is being done, especially in tax, does not bog down the possibilities of growth. So we need to see more tax breaks, especially for this, the SMEs, so that they can sort of accelerate that growth. And, it will also act as a booster. You see, we can't just work with borrowing and austerity without building the investment base.
That's very true. Emily, what's your take on, what Kishore just mentioned when it comes to that taxing of a lot of businesses, which sometimes is counterproductive, because then you're more likely to stifle the business as opposed to actually allow it breathing room and to grow?
I think on the taxing, it needs to be considerate to the size of the business and the requirements. Because when you look at sometimes permits that you need to pay for to run the business, and now the tax that is now imposed, especially now when you look at the small companies or small businesses being taxed and the requirements to do such businesses, sometimes it will get to like killing such businesses. But with the balance of proper taxing and the requirements to run such businesses, I think it will allow the business to bloom, and the ripple effect will be true, such that as the businesses make more money, they'll be able to pay tax, and there'll be growth in terms of revenue, and also it will ideally be a ripple effect in terms of employment.
So even as, thank you for that. So even as we actually wind up, I just want to get your final thoughts on your expectations, your predictions for 2020 and the economy in general, and of course the market as well, where you see us going, and what you think needs to be done to keep a strong momentum going. Sarah, I'll begin with you.
So in terms of growth, we expect growth to be relatively higher this year. So last year, probably growth will come in for 2019, probably 5.6%. This year, the World Bank predicts forecast is to grow around 6%. So higher growth, mainly driven by agriculture. And then manufacturing is also likely to pick up. So as growth improves, that should be positive for the market. So company earnings increased. So in particular, Safaricom, earnings will be good. Banks, with the removal of interest rate cap, that should be really positive for them. And then EAPL also would see increased consumption, so consumer demand has increased. And then in the fixed income space, that will be dependent on a government borrowing program. So this year, we've seen the already raised the domestic borrowing target. And so overall, we expect yield to remain relatively flat with a slight upward bias.
All right,
Yeah.
Kishore, what about you?
Well, just speaking on what Sarah said, I think that estimate, and now seeing that the locusts have come and we have too much rain, we might need to look at it, because too much rain is not that good for agriculture, because then our seasons are messed up. Now January would probably be a bit dry, and April, the planting season is messed up. Our greens are getting lost because we don't have dryers. So I think we might see a bit of an adjustment going forward. And because of the delay in that effect of, say, what we're seeing with the interest rate capping being removed, which of course another positive which maybe we should have mentioned is that foreign investors, you see, we need to have competitive markets. So the interest rate cap, the moment it came in, it meant there was an interference in government with competitive markets, which means foreign investors shied away from our market. Of course, there were other issues with, say, things like the US-China trade war, which affected our markets. But we've seen that since the interest rate cap was removed, that foreigners have actually come in very heavy. We, in fact, saw them drive the market up to very high levels in December, which is unusual, and up to now, January. So that means that we are getting better confidence. Hopefully, we are going to see as we go along that once all the new things that are being done in agriculture start hitting, then it will also boost the economy. So I think optimism, yes, but a little bit of pessimism in there.
Okay.
Yes.
All right, that's a very realistic view then. And Emily, what about you?
My thought will be it is positive, considering that you've now taken the measures to correct probably what was going wrong, as we saw in 2019. Now it's time to build up. So we are seeing a positive in terms of even companies that probably had restructurings and all that. So that's done. Now it will be time to build up on the new products in the market. The derivatives is now set up, especially when you come to the exchange. Now it's time to build up towards the products that were launched last year. And now, just to add on the interest rate capping, it will now allow pricing of even corporate bonds, because with the cap, it had somehow made the pricing a bit hard, considering of the rating of the corporate bonds compared to the government bonds. And when you look at the yield curve last year, on the mid-longer term, we had like a plateau towards the mid-long term. And now with the rate cap repeal or removal, we'll have now pricing of corporate bonds. So we'll expect more corporate bonds at least coming into the market, or such products coming into the market. So my view will be that it will be it is positive. There'll be growth in the economy.
All right, thank you so much for joining me, all of you, and it was really a pleasure to have you, and of course all your insights as well.
You're welcome.
Thank you.
All right, well, there you go. Sarah Wanga, Samuel Gishohi, and Emily Keegan were definitely people who we wanted to hear from, who told us their views and their insights on a lot of issues that we've been seeing throughout 2019, as well as what we're expecting them to have an effect for in 2020 when it comes to the economy. And resoundingly, there's cautious optimism that perhaps 2020 will be the year that we will see a lot of positives, and that Kenyans will be able to build on, so that we have an even stronger economic base going forward. Well, that brings Trading Bell to an end this episode, of course, but you can keep up with us. We have our social media handles right there on your screen below. And of course, our next episode will have even more. So do keep up with the Trading Bell. My name is Malika Kazia.